Billions of dollars lost in the blink of an eye, fortunes wiped out overnight, and investors left scrambling in disbelief. From fraudulent schemes to overhyped companies, the stock market has seen its fair share of catastrophic failures. Stick around, some of these stories are shocking enough to make you think twice about your next investment. Today, we're diving into the top 10 biggest fails in stock market history. Be sure to hit that subscribe button and ring the notification bell for more similar videos. The dot-com bubble. In the late 1990s, the internet was a wild west of investment. Companies with little more than a website and a vague business plan were attracting millions in funding. Investors believed the internet would revolutionize everything, and they were right, but not every company was ready to deliver. Between 2000 and 2002, the bubble burst. Major companies like Pets.com and Webvan went bankrupt, and the Nasdaq index lost nearly 80% of its value. Over $5 trillion in market value evaporated. Pets.com, for example, raised millions through an IPO but collapsed within 9 months due to unsustainable losses. A headline from the Wall Street Journal summed up the chaos, saying, "The gold rush is over. Internet startups collapsed under pressure." The Enron scandal. Enron was once considered a darling of Wall Street, known for its innovation in the energy sector. But behind the scenes, the company was hiding massive debts through a web of fraudulent accounting practices. In late 2001, the truth unraveled. Enron filed for bankruptcy, wiping out $63 billion in market value and destroying the savings of employees and investors. CEO Jeffrey Skillings and other executives were convicted of fraud, with Skilling famously defending their practices by saying, "Our accounting methods were creative but not illegal." The Enron scandal led to sweeping reforms, including the Sarbanes-Oxley Act, which changed how companies report their finances. Lehman Brothers collapse. The collapse of Lehman Brothers was the spark that ignited the 2008 global financial crisis. Once the fourth largest investment bank in the US, Lehman crumbled under the weight of risky subprime mortgage investments. By September 2008, Lehman had filed for bankruptcy, marking the largest bankruptcy filing in the US history of all time. With $600 billion in assets wiped out, investors lost every single thing, and the Dow Jones plunged over 500 points in a single day. Critics slammed Lehman executives for their reckless behavior, with one financial analyst saying, "Lehman Brothers didn't just play with fire, they doused themselves in gasoline first." Black Monday. On October the 19th, 1987, the stock market experienced its largest single-day percentage drop in the history. The Dow Jones Industrial Average fell by 22.6%, wiping out over $500 billion in market value in just a few hours. The crash, later dubbed Black Monday, was triggered by a combination of computerized trading platforms, high interest rates, and geopolitical tensions. Panic selling spread like wildfire as investors scrambled to get out before losing everything. Volkswagen's short squeeze. In 2008, Volkswagen briefly became the most valuable company in the world, but not for the right reasons. The chaos started when Porsche announced it had acquired a 74% stake in Volkswagen, triggering a massive short squeeze. Hedge funds that had bet against Volkswagen were forced to buy stocks at skyrocketing prices to cover their losses. At one point, Volkswagen stocks surged over 300%, hitting £1,000 per share. One trader described the frenzy, saying, "It was a financial carnage. Funds lost billions in a matter of hours." The Wirecard fraud. Wirecard was Germany's pride, a fintech company hailed as a European rival to Silicon Valley giants. But in 2020, it all came crashing down. An audit revealed that 1.9 billion euros, roughly a quarter of Wirecard's balance sheet, was missing. Wirecard CEO Marcus Braun resigned and was later arrested. The company's stock plummeted from 100 euros to under €1, wiping out billions in market value. Investors were left in shock, and one financial expert described it as Germany's Enron, a fraud of unimaginable scale. The Tulip Mania. Let's go back to one of the earliest recorded financial bubbles, tulip mania. In 1630s, tulip mania became a luxury commodity in the Netherlands. Prices for rare bulbs soared, with some selling for more than the cost of a house. But in 1637, the bubble burst. Tulip prices collapsed overnight, bankrupting countless speculators. Historians debate the exact scale of the disaster, but it remains one of the history's most iconic examples of speculative mania. As one contemporary writer put it, the love of tulips was a madness that consumed reason. GameStop short squeeze. The GameStop saga of 2021 was a David versus Goliath story for the ages. Retail investors organized on the Reddit forum r/Wall Street Bets targeted hedge funds that had heavily shorted GameStop stock. By banding together, these retail traders drove GameStop prices from under $20 to over $400 at its peak, causing hedge funds to lose billions. The Melvin Capital, as one of the most prominent short sellers, required $2.75 billion bailout to survive. One Reddit user famously posted, "We're not leaving until the moon." The housing market crash of 2008. The 2008 housing market crash didn't just devastate the real estate sector, it brought the global economy to its knees. The crisis was fueled by subprime mortgages, which allowed people with poor credit to buy homes they couldn't afford. When the housing bubble burst, banks holding mortgage-backed securities faced massive losses. Companies like Lehman Brothers collapsed, and millions of homeowners lost their properties. Economics later described the crash as a perfect storm of greed, ignorance, and regulatory failure. The Wall Street crash of 1929. The Wall Street crash of 1929 wasn't just a financial disaster, it was the beginning of the Great Depression. Over 5 days in October, the stock market lost nearly 30% of its value, erasing billions of dollars in wealth. The crash was fueled by speculative buying, where investors borrowed money to buy stocks, creating a bubble that eventually popped. By the end of 1929, over 4,000 banks had failed, and unemployment skyrocketed to 25%. One newspaper headline from the time read, "Wall Street lays an egg. Nation in panic." So there you have it, the top 10 biggest fails in the stock market history. Which one of these shocked you the most? Let me know in the comments below. And if you want to learn more about the highs and lows of finance, check out this video next. Thanks for watching, and I'll see you in the next one.